In this video, I'll be sharing with you the common types of shorting strategies that a lot of investors think about in the stock market. And if you haven't gotten a chance to watch my first video on shorting, click up here. Now, before we start, I find that the most important thing about shorting is to have a short-term perspective. If you've invested before, you might notice that stocks can take quite a while to go up, but when they come down really quick. So once oftentimes the bad news is out on a stock, it doesn't really take long before it finds a bottom or a trough. So that might be the best time to get out. Okay, so we'll begin with some of the strategies. So the first category are pretty much your typical shorts. These are kind of stocks that kind of look expensive or have been way overbought. They've been driven up so high in such a short time period that it really doesn't make sense. It's just people playing the psychology game and driving demand. Another type of typical short would be expectations. Stock might be down this quarter because expectations going into the quarterly results are really high, so it's easy to disappoint, even with average results. Another type of typical short is if a stock is crashing down, people might want to get into that sell-off momentum, so they also short to add pressure into the stock. Lastly, another type of typical short is, you anticipate a sort of news coming on really soon, and before that date, you're building up a short position, and you basically sell or you cover your position after the news passes. Now, I call these typical shorts because there's oftentimes not a lot of reason as to why these companies are bad. In a way, they're more so really quick ways to profit, and they're just ways for people to kind of take a very short-term perspective. Thematic shorts. So you're basically shorting based on generally accepted themes. So something like, say the real estate or retail market is getting tough. So perhaps you find specific companies that you want to short, or maybe you just want to short everything in the industry, maybe through like an ETF. Or perhaps if you have a bigger sort of view, you might think a whole country is not doing well. So maybe an idea would be, China and Europe are suffering from the Trump trade war. So perhaps a recession might hit these countries soon, and we'll try to short the entire market or the entire country. Frauds and crooks. Now, obviously, these are just companies that you short because, there might be a pyramid scheme, or they're cheating their customers, employees. They're pretty much gaming the stock market with sort of like a fake business, or they're just running a bad business because, say, maybe management sucks, or the products are actually faulty, they don't really work, and say they've built up some fake orders, so their accounting looks really nice, but when it comes down to it, they're not taking any money in. Now, these shorts are often harder to catch without doing some sort of extensive homework or analysis because the company is trying to hide something, or they're fabricating some of the news that they tell investors. And basically the best way to do so and to figure out if companies are frauds and crooks is to go into the business, kick the tires, check the business out, see if it really does have potential or it's crap. Bankruptcy. So usually once frauds and crooks are caught, they tend to become bankrupt cases next, just because, the word's out. There's no real business behind the stock anymore, so the whole thing doesn't work anymore. But for the companies that weren't originally frauds and crooks, you'll often find that it's because these businesses had too much debt to work with, they couldn't make a profit, they had trouble managing their money, the brand was dying, they didn't have any innovation to compete anymore, or say they were too aggressive with their growth plans. We're making 100 stores per year, and there's too many stores, so basically you kind of don't work out as a business anymore because people don't buy that fast as you're growing your business. Now, I found that the most difficult part about trying to short something that's almost in the near brink of bankruptcy is that even the smallest bit of positive news in the stock market can shoot the stock up. And that could easily cause a margin call for people who are shorting. And normally these would be called short squeezes. A case would be, Sears is a company that's kind of doomed anyways. But Amazon came out and had a partnership deal, and on that day, Sears stock like went up like 20-30%. Now, if you're shorting that, I mean, that kind of sucks, but I mean, it's still a kind of doomed company, but one small light of positive news can be the worst thing for short calls. Portfolio protection. This is sort of when you have a small portion of your investments that are short positions, in case of a market correction or a crash. So when that happens, you're not at a total loss. But of course, when the market does revive or rally, then you won't be at a total gain. So it's best that when a correction or a crash does happen, you have to be able to cash out from your short positions on time. Lastly, the pair trade strategy. This is where you buy one idea and you short the opposing idea. And what happens is that the only thing you really care about is the direction of these two ideas, not the stock market movements. For example, say you think that Pepsi is, the better beverage company, so you buy their stock. And at the same time, you think that they're going to destroy Coca-Cola, so you make a short position on Coca-Cola. So in, say, a year, Pepsi increases 10%, while Coca-Cola actually decreases 10%, then in your portfolio, you've won both your trades and you should be up 10%. And in the case where, say, the entire beverage industry fell 10%, then your Pepsi position, you would have lost 10%, but you would have gained 10% on Coca-Cola, which theoretically means your portfolio made 0%. And also the case with, say, the stock market rallied 10%, again, you would have won in Pepsi, but lost in Coke. So your portfolio would have had a 0% return. Now, the pair trade strategy is a little bit more complex. I would recommend it for investors who follow stocks or ideas very closely and want to actively consider swapping their buy and short positions with the same company over time. And this is usually something for people, say, who follow these beverage companies or follow these ideas very closely, maybe who works in the industry and can follow these trends very closely and know when to switch in and out from an idea.